Welcome to Retirement in a Nutshell, and this training video on how to enter inflation and tax information for a client. The inflation taxes data entry screen is pretty straightforward. Enter the inflation rate you want to use for client living expenses that continue for life. The program will take the living expense number the program calculated using our patented backwards calculation for the current year and apply the inflation rate for each year forward through the rest of the cash flow years. This will set the target against which all cash flows in future years are compared. It will show if the client will have a surplus, a shortfall, or be about the same as the current year, taking inflation into account. There are two data entry fields for taxes, one for federal income tax and one for state income tax. The taxes can be entered as either a percentage or as a dollar amount. The program knows that any number over 100 is a dollar amount. It is preferable to enter the dollar amount from the client's latest tax return, as long as their taxes for that year are representative of their normal taxes going forward. You want the actual income tax amount calculated for that year without taking withholding into account. You also do not want to include the amount calculated for self-employment tax, since the program already calculates that for you and subtracts it from income. By using the tax return, it is more accurate since it takes into account any deductions, credits, or other unique tax items for that client. If you do not have access to the client's tax return, the next best alternative is to use a tax table calculator to estimate the dollar amount of the client's taxes, taking into account both contributions to retirement accounts and the standard deduction. There's a tax tables button that links to a tax calculator that will allow you to estimate the amount of your client's federal and state taxes until you can get their tax return and verify their actual numbers. Let's open the link and take a look at how the calculator works and how you can use it to estimate your client's taxes. Let's select 2018 for the tax year and enter an income of $200,000 for a couple filing jointly. These clients are not retired, so there is no unearned income from retirement accounts and no long-term capital gains. The calculator enters the standard deduction for a couple in 2018 of $24,000. And let's enter contributions this couple makes to their 401k and retirement accounts of $20,000, which results in a taxable income of $156,000. Then we scroll down to see the results. There's a drop-down list of states, so the calculator can also give you the estimated state taxes for this couple in their state of residence. You can ignore or unmark the boxes for Social Security and Medicare taxes since the program already makes the necessary adjustments. You should also ignore the percentages calculated for average or marginal tax rates because the calculator uses a different mathematical approach for these percentages than Nutshell does. The dollar amount of federal and state income taxes are displayed in the right column. Record the amounts and enter those values as dollar amounts on the inflation taxes screen. You can double check the amounts when you get your client's tax return. If you don't have time and want to enter a quick tax estimate until you get more information, you can enter a percentage for taxes. Because some states have high income taxes and some states have no income tax, we have provided a place to enter both. In reality, the program adds the two together and just uses or displays the total, so it doesn't matter how you split it up. The percentage you enter represents the effective rate and not the marginal rate. Using the 2018 dollar amounts the calculator displayed for a couple filing jointly and making $150,000, the total federal and California state effective rate is about 15%. For a couple with $200,000 of income, it would be about 20%. Those are probably good ballpark percentages, and you can adjust up or down slightly based on your state or if the client's income is higher or lower. There is an entry tab entitled Override Expenses. If you select that tab, it allows you to enter a living expense amount manually and the year you want that expense amount to start. The program will still apply the inflation rate you entered to that amount going forward. If you enter an expense amount for the current year, it will override the backwards calculation of expenses, and the cash flow report will show a positive or negative cash flow for the current year. That is not recommended unless your client insists, because it will not allow the program to calculate the client's current living expenses or force them to disclose where all their income is going and account for every dollar. If the client has itemized their budget and wants you to use their number, it is recommended you let the program calculate their living expenses so you can compare it to the client's calculation and see if the numbers are the same or there is a disparity you need to discuss with the client. Clients often think they know exactly what they are spending, but there may be some items they are not fully counting that the program does. If the expenses for the current year are off, the whole cash flow analysis will be off and compounded by inflation in future years. The most common use for the alternative expenses is to reduce expenses somewhat at retirement as one of the strategies to address any shortfalls the report displays after retirement. If the client has large shortfalls after retirement, it may require a combination of several strategies to address the situation. If you want to reduce expenses or apply other strategies to address shortfalls, it is recommended you go to the Plan What If menu item and make a what if copy of the plan and make the changes on the copy so you keep the original plan you prepared unchanged for comparison purposes. There is also a tab for alternate taxes. Most planning tries to maintain the client's standard of living after retirement, so the tax rate in retirement should be about the same as during their working years. However, if there is a big change in income at some point, you can enter an alternate tax rate or amount and the year you want that to start. That concludes the training for inflation and taxes. If you still have any questions, please check the frequently asked questions or call our toll-free number and we'll be happy to help you. Thank you.